$8,000 in annual dividend income is about to vanish from your healthcare portfolio, and your broker isn't warning you yet. If you hold Abbott, Johnson & Johnson, or Medtronic in a retirement account or dividend portfolio, tariff implementation starting in Q1 2025 could erase $6,000 to $9,000 from your portfolio value and cut your dividend check by 25-33% within 18 months. Most retirees think tariffs only affect prices at the checkout. That's the wrong belief, and it's costing you money right now. Here's what Wall Street won't tell you. Abbott, J&J, and Medtronic source 15-25% of medical device revenue from China manufacturing, per their 10K filings. When tariffs hit, operating margins compress 100-200 basis points. That forces dividend cuts. Historical precedent proves it. During the 2018-2019 trade war, the medical device sector PE multiple collapsed from 18x to 15x earnings per FactSet. Dividend payments fell 2-3% across the board. Device makers don't absorb tariff costs, they pass them to hospitals and patients, then cut payouts to shareholders. By the end of this video, you'll know the exact tariff dates, which device makers face the highest China exposure risk, and whether you should reposition your portfolio before February 2025. Let's start with the timeline. Trump's administration has signaled tariff orders for Q1 and Q2 2025. That's January through June. The White House office typically announces specifics 30-60 days before implementation. We're already seeing preliminary statements targeting Chinese electronics and medical devices at rates of 15-25%. For a company like Abbott, which manufactures diagnostic devices, point-of-care testing systems, and imaging components in China, even a 15% tariff on incoming materials forces a choice: absorb the cost and shrink margins, or raise prices and risk losing hospital contracts. Neither option is good for shareholders. Now the dollar impact. If you're a retiree with $500,000 in your portfolio and 15% in healthcare, standard for income-focused investors, that's $75,000 in Abbott, J&J, and Medtronic combined. A 5-8% sector correction, conservative by historical tariff shock standards, cost you $3,750 to $6,000 in unrealized losses. But the real hit comes from dividend cuts. If J&J's device division cuts its payout by 2-3%, conservative estimate based on 2018 precedent, and you're collecting $75,000 times 3% yield equals $2,250 annually. A 5% cut costs you $56 per quarter, or $225 per year. Multiply that across Abbott and Medtronic, and a household losing 3% on a $75K healthcare position loses $500 $250 annually, just in dividend income. For retirees drawing 4% annually, that's critical. If your portfolio is worth $500K and you're targeting $20,000 in annual distributions, a $1,000 dividend cut forces you to either sell stock, locking in losses, or reduce lifestyle spending. Some forced RMD takers may need to accelerate withdrawals to make up the gap, pushing them into higher tax brackets. So what's the play? First, check your 10K filings. Abbott, J&J, and Medtronic all disclose China exposure percentages in their annual reports. Abbott's China revenue is roughly 18% of device sales. Medtronic is around 20%. J&J's medical device division is roughly 15-17%. Next, model a downside scenario. Assume a 7% stock price decline in the sector and a 3% dividend cut on a $75K position. That's $5,250 in unrealized losses plus $225 annual income loss. If that breaks your retirement plan, consider trimming your healthcare concentration to 10% and rotating into dividend stocks with lower China exposure, utilities, consumer staples rate. The decision window is narrow, January through mid-February 2025. After tariff orders are finalized, repricing happens fast. You'll want to decide before April earnings calls, when device makers first signal margin pressure. Here's the bottom line. Your belief that blue-chip healthcare stocks are insulated from trade policy is historically backwards. The 2018 trade war proves tariffs cut device sector dividends within 6 months and reset PE multiples for 18-24 months. If you're a retiree with concentrated healthcare exposure, you need a repositioning plan now, not in April when dividend cuts are announced. For the full tariff exposure modeling spreadsheet and the 9-company comparison I couldn't fit here, check the companion book Market Cycles Decoded, link in the description. If this changed how you're thinking about your healthcare holdings, hit subscribe. Next video, the 3 sectors that win when device makers lose and how to rotate into them tax efficiently. Dropping Thursday. Ring the bell so you don't miss it. What's your biggest healthcare holding? Let me know in the comments. I'm tracking which stocks get hit hardest as tariffs roll out. Markets reward the patient and the prepared.